Alright, we're looking at June 2012. And the question I'm going to start with, obviously, is question 1. Pyramid. Let's see if we can't write it properly so that people have got a chance of knowing what I'm doing. Question 1, pyramid. It's a consolidated statement of financial position. It's March 2012. The start time, I should make a point of that. Start is 1341. So finish, that's 1945. 1426. Okay. Point number 6. I tend to read these notes from the last notes first, because I'm not going to get anything from looking at the numbers in the question. The 2 columns of figures. I might as well see what the problems are. Point number 6. There were no impairment losses, so we've dealt with point number 6 straight away. There's no impairment in working 2 for the goodwill. Point number 5, other equity investments. Look on the pyramid balance sheet, other equity investments 2000. They carried at fair value, and that's increased by 800,000 to 2.8 million. So no problem there. We bought 1.5 million shares in Cube. This is a 30% holding. That's interesting then, because under the new IFRSs, it's potentially the case that we have effective control. Do I want to change the colour scheme? No. I don't want to change the colour scheme. Why is that inviting me to change the colour scheme? We'll use the equity accounting consolidated financial statements for the investment in Cube. So that's easy enough. Just remember it for point working 1, working 3, and working 5 we'll need it for, to calculate the value of the investment in the associate company. Point number 3, we sold goods to Square at cost plus 50, so there's PUP is going to be involved here. And there's reconciliation of current accounts. Sales and purchases don't reconcile. Receivables and payables don't reconcile. So we've got some goods in transit, and we've got some cash in transit. Alright, well we can sort that out, and there's PUPs as well. So yeah, we can work that out, okay. Number 2, immediately after the acquisition, Square issued 4 million loan notes. Loan notes do cause... Do you want to change the colour scheme? No, I don't want to change this colour scheme. Don't ask me again. Immediately after the acquisition, we issued 4 million loan notes. These loan notes seem to cause students problems, and this is the subsidiary borrowing money. It's issuing 4 million loan notes. 2.5 has been lent by the parent company, and the other 1.5 is to the outside world. So if we look, yeah, there in the pyramid balance sheet, we've got loan notes in Square of 2.5 million, and in the Square balance sheet, we've got 11% loan notes of 4,000, and they cancel. So 2.5 investment in loan notes cancels against 2.5 of the 4 million liability in Square. Just occasionally, Steve Scott asks a question where part of the purchase consideration is in the form of loan notes issued to the former shareholders of the subsidiary company. But that's not the situation here. And don't ask me this again, please. Do I want to change the colour scheme? No, I don't want to change the colour scheme. But ask me, and don't show me this message again. We'll do that one. But that's not the case here. The case here is simply the immediately after the acquisition. It's not part of the purchase consideration. And then finally, point number 1, fair value. It always happens. It's always a fair value exercise in question 1 of the F7 exam. Item of plant had a fair value. The date of acquisition, remaining life for 5 years. Ignore the deferred tax relating to this fair value adjustment. Okay. And we've done unrecorded deferred tax liability, which was unchanged a year later. Pyramid's policies to value NCI at fair value. Okay. For this purpose, the share price of 350 is representative of the fair value of the shares. Right, well, let's start then at the opening paragraph on the 1st of April. Remember, we're going to 31st March 2012. So on 1st of April 2011, so it's a full year. So working 1, we have the parent pyramid and the subsidiary square. We've got 80%. There's a 20% NCI. And I know from point number 4, we also have the associate cube. And that was bought, oh look at that. That was bought on 1st of October 2011. So October, November, December, January, February, March. So it's 6 months pre, 6 months post. But just for the associate company. This one is a full year. Okay. That's working 1. Working 2, goodwill. We've got a cash payment of 88 cents per share, deferred for a year, and we've recorded the share exchange but not recorded the cash consideration. We had an immediate cost of capital of 10%. We have recorded the share exchange, we've not recorded the deferred cash. We had a cost of capital of 10%, that's acceptable, that's easy enough. So, cost of shares then. Cost of investment. Cost of the investment was 80% of shares, so it's 80% of 10,000 square shares. That's $10,000, and they are shares of $1 each. I need to be careful with that. So that's important to remember, and we have recorded the issue of shares. So it's 24,000, and it's a 1 share for 1 share. 80% of 10,000 is 8 at $1 is 8,000, and we're told from the question that the investment in square, so there must also be a premium of 16, because we're told that the cost of the investment in square is 24, so that must be 8,000 at $2 premium. Now that has been recorded. The share premium account, if you look in the pyramid balance sheet, the share premium account is 17,006. Well, 16,000 of that came from this share issue. Then we've got deferred consideration. Deferred for 1 year, it's cost of capital 10%. Cash payment 88 cents per share acquired. We've acquired 8,000 shares, and we're going to pay 88 cents per share, but it's delayed for 1 year. So discount it times 1.1 divided by 1.1. That's 8,000 then at 80 cents. 8,080 cents is 6,400. Gives me 30,400. That's the cost of the acquisition so far as we are concerned, but then they've got the value of the NCI, and the question tells me that we're using equity accounting. There, put the end of paragraph note 1, policies to value NCI at fair value. Share price of 350 is representative. Now, well, they have 2,000 shares. There were 10,000 in total, and we bought 80%. So the NCI's got 2,000, and they're worth $3.50 per share. That's 7,000. So 37,400 is the value that we've placed on the subsidiary square. Now we need to compare that with the fair value of the net assets at date of acquisition, and this is calculated as being shareholders' funds. And we know that shares are worth 10,000, and I'll put premium in because sometimes there is a premium in the subsidiary, but there isn't in this case. Retained earnings brought forward 18,000. And then if it were a time apportion problem, it isn't, because it's a full year. If you're looking at working 1, it's a full year. But if it were a time apportioned one, then there would be, say, 3 months pre-acquisition profits to go on top of that 18. But that's not the case here. It's just a straightforward purchase acquisition on the first day of the year. We do have some fair value adjustments though. in paragraph 1, and it will invariably be the case that there are fair value adjustments, and they will invariably be in paragraph 1. This time we have an item of plant. It's got a fair value 3 million above, so PPE, and we need to be careful here because at the date of acquisition it's got a remaining life of 5 years. We have the plant. Let's assume, just for illustration, that we had 15,000 plant brought forward, and now we're told that there's another 3,000. Well, this 15 will already be being depreciated, but that 3,000 is not recorded in the subsidiaries records. So when we notionally increase the PPE by 3,000, we're then going to have to depreciate that 3,000 over the 5 years. So 3,000 over 5 is going to be 600 additional depreciation this year within the subsidiaries retained earnings calculation. I'm going to get rid of that now because it's messy. It doesn't have any part other than to remind us that we need to remember that 600 depreciation. We've also got deferred tax. It's an unrecorded deferred tax liability in paragraph 1, that second bullet point in paragraph 1. So we've got a 1 million liability, and that's unchanged. We need to make a note of that as well. I'll just add this up, and then I'm going to start making notes on my question paper. 30,000. That means we've got goodwill of 7,400. And there's no impairment. I'll write it in because you need to get used to the idea that there may be impairment in the future, and that's where it will go. Therefore, on CBS, Consolidated Statement of Financial Position, I've got this 7,400. Now I'm just going to start making notes on my question paper here because I've got to increase the assets. I need to add, what is it, 3,000? Yeah, plus 3,000 on the assets, plus 3,000, minus 600 for the depreciation, okay, and the retained earnings I've got to put minus 600 as well this year. Okay, that deals with that. Deferred tax, I need to increase the deferred tax in the subsidiary by 1,000, and that's going to come off in working 3 because it's a deferred tax minus 1,000 in working 3. But that's a pre-acquisition 1,000. Alright, now let's have a think about these other points. We've dealt with point number 1. Point number 2, we'll have a look at point number 2. The loan, we need to cancel 2,500 asset in pyramid against 2,500 long-term liability in square, and leave 1,500 LT liability for consol. And that deals with point number 2. Point number 3. Let me read point number 3 again, because I seem to remember reading the forum comments. What did you think of the F7 exam? And there seemed to be a lot of unhappiness about this point number 3, about cash and goods in transit, reconciling and non-reconciling current accounts. So we'll have a look at that. And in Pyramid's books, in P's records, there's an account called the Square current account, and in S's records there's an account called the P current account. And according to the Pyramid receivables, per the question, Pyramid thinks that they are owed 4,400 by S, and in the question it tells us that per the question S has got a record of 1,700 owing to P. Those are the receivables and the payables, the receivable in Pyramid and the payable in Square. But look, there's 1500's worth of goods on the way from Pyramid to Square, and Square has not yet received these goods. When it does, it's going to debit purchases with 1,500. The rule with in-transit items, if you remember, the rule is to accelerate the item into the records of the receiving company. So I'm going to increase the S purchase figure by 1,500. Now that's going to change cost of sales, isn't it? It's going to increase S's cost of sales, but then there's also an increase in the stock in Square, the closing inventory. So whereas that 1,500 is going to increase cost of sales, it is also going to increase the Square closing stock, and that will bring down the cost of sales. So in fact, there is no effect on the S profit figure. This debit effectively the debit will increase the inventory in Square and increase the liability to the parent. That's the effect of that 1,700. In addition, the second paragraph here, on the 27th of March, Square has sent some money to Pyramid. The payment accounted for the remaining difference. Well, at the moment I got 4,400 there and 3,200 there. So the difference is 1,200, 1,002, and that's going to be accelerated into the P records. So I'm going to debit cash and credit the S current account with the 1,002. Now if I carry down this adjusted figure, that's 3,002, brought down 3,002. And same with this one, I've got a 3,200 total, same figure in the other side. I was lazy here, and carry down 3,002. And that's the position we're now in, having made these two adjustments, the purchases of cash in transit and the goods in transit adjustments. And now we're reconciled with, so we have 3,002 receivable, 3,002 payable, and I'm going to make a note of this now on my question paper. I'm going to put minus against the receivables, minus 3,002, and against the current liabilities, minus 3,002. And it doesn't matter where they go, it's just a consolidation adjustment, so I'm not taking it off neither P's receivables or specifically Square's payables. It doesn't matter. All I'm doing is adding that figure to that figure and taking off 3,002. Add that figure to that figure and take off 3,002. That's all we're doing with that cancellation exercise. Okay. But we do have another thing, and that's at the top of page 3 in the exam, and that is that Pyramid sells goods to Square at profit. Cost plus profit equals selling price, and it's a 50%, and it's 50% cost plus. You could have said it's a 50% markup, so that's 100. So selling price is 150%, and the profit element is 50 over 150 times the sale price, and the sale price was 1,500 goods in transit. This sells that 1,500 there has got 150, so 1/3 profit in there, PUP, and that PUP needs to reduce retained earnings and reduce closing inventory in, who made the sale? In Pyramid. So debit retained earnings in Pyramid, credit closing inventory in Pyramid with that 500. Cube, point number 4, the detail of the associate. We've got 1.5, Cube's retained profits had increased. Alright, so we could actually call this, couldn't we? We could call this working 5A, the value of the investment in associate, and it's a 30% holding. The cost of the investment was 6, according to the question, the column of figures, 6,000. A share of post-AC is 30% of. Now there's no time apportionment here. This is a tricky little thing that he's done here. He said the retained profits had increased by 2 million over their value at 1st October at date of acquisition. So it's straightforward. 30% of 2 million. What he could have done, what he could have said was that the profit by Cube in the year to 2012 was 2 million, and then we would need to time apportion. But that's not what he's done this time. He said it's 2 million since acquisition. 30% of 2,600,000, 6,006, less any impairment. I know what the answer to this is because I can remember it, but point number 6, there were no impairment losses. So 6,600 is on the consolidated statement of financial position. Other equity investments, I will make a note of it. Other equity, we need to increase the asset by, did we say 800,000? And we need to increase retained earnings by 800,000. And that's it, we should be ready to go. Let's have a look at working 3 then. Just out, we're done working 2. Working 3, consolidated retained earnings, pyramid and square. Per the question, retained earnings 30,200 for pyramid, and for square 30,200 for square, and square is 26,000. I'll tell you what I'm going to do. I'm going to put cube in. This cube is just 2,000. That's post-AC. That's entirely post-AC. Pyramid and square, these are cumulative. But I'll put the cube in there because sometimes we do need it. Sometimes we did by the associate company some time ago. Then we've got some fair value adjustments. We still have these assets. We still have the deferred tax liability. So we've got the deferred tax of 1 to come off, and we've got the plant, which was 3 to go on, but if you remember, the depreciation on the plant was 600 to come off. Then we've got the do we have the loan interest? Yeah, all interest has been paid and received. With cancellation of the loan interest, it has been recorded. I've not done this, I've not dealt with this, but this loan interest has been accounted for. So within this 30,200, the pyramid has accounted for a year's worth of loan interest on 11%, 2.5 million. And within this payment, within these post-acquisitions, all this is cumulative, the square has also accounted for an intergroup payment. So I'm going to cancel this out. For the purposes of working out NCIs, it is important that we should not be capable of manipulating this subsidiary profit figure to damage the NCI's interest. So cancellation, this is 11% on 2.5 million for 1 year. That's 275 and 275 to add back on to the subsidiary. Then we've got PUP, and that was in the parent company. That was a 500 adjustment. And we've also got the unrolling of the discount, where we discounted the cash payment up here. There. We discounted this by 10% for 1 year. 8,000 times 88 cents is in fact 7,040, but we've only included it 6,400. But now, of course, we're 1 year nearer to paying it, so we have to unroll this as a finance charge. It's payable tomorrow, so the unrolled discount of 640 is a finance charge within the parent. We've also got the increase in the investments. That was point number 5. The investments have gone up by 800. So we should be in a position of adding this up now. I can't think of anything more. We've got to take off the pre-acquisitions. Cube, we're still 2000, but that's all post-ACCA. Square 26, 25, 28, 27, 4, 27, 675. And here we've got 30,002, 31, 30, 29, 860, 29, 660, 29, 600, 29, 585. Just check that. Well, I've got my calculator, I can check it. I think it's 29,585. Just let me do it on the calculator. 30,200 minus 275 minus 500 minus 640 plus 800 equals 29,585. Now I need to take out the pre-ACCA, and that's in working one. It's here. 18, 21, 20,000 pre-acquisition. Nothing to take off there because it's entirely post-ACCA. So 7675, and therefore post-ACCA. And our share was 80% of that and 30% of that. 80%, 7675. 7675 times 0.8 is 61400, 6140, and cubed 30% is 600, 29, 35, 36325. Check it. 36325, and no impairment. There's no need for you to write that down, but I do it because you get used to seeing the concept of the idea of impairment at the end of working 3. Working 4A, this is the investment, this is the NCI, I'm sorry, NCI, and their share is 20%. Value at date of acquisition was 7,000 from memory. Working 2, yep, 7,000. Value at date of acquisition 7,000. A share of post-ACCA retained. Share of post-ACCA retained is here. There's the post-ACCA retained. It says post-ACCA, and we're in the retained earnings. So share of post-ACCA retained is 20% of 7675, which is 1535, I think. 1535. 8535 less their share of impairment. Now, if they had been valued on a proportional basis and there had been an impairment, they would not have been charged. If they had been valued on a proportionate basis, they would not have suffered any goodwill impairment. But they're not. They're valued on a fair value basis, and therefore they are responsible to be charged with their share of any impairment in goodwill. But point number 6 says there are no impairment losses, no impairments, so 8535 is the NCI on the balance sheet. And that, I'm thinking, should be all we need to do. Consolidated statement of financial position, INCA, working 2, that's the goodwill, 7,400. Investment in associate, that's working 5A, and we did that in the middle of the year, didn't we? There we are, 6,600. We've got other equity investments. They've moved up from 2 million to 2.8. We've got PPE. PPE, according to the question, we've got, look, I made a note there, 38.1 plus 28.5 plus the fair value minus the 600, the additional depreciation. So that gives me 50, 66, 69,000. Looks like 69,000 to me. Anyway, we'll add it up and see. 13, 14, 15, 16, 8, 85,800. Inventory. Inventory from the question is 13.9 and 10.4, but there's some inventory in transit of 1.5, but there's also PUP to take off. So 13.9 and 10.4 is 24.3, 24.3, 25,003, I think. Receivables 11.4 plus 5.5. Do you know, one thing I didn't do is I didn't record on my question paper this cash in transit. Cash in transit was what, 1,002. I should have put that on my question paper. Then we've also got the cancellation, haven't we? We've got the 3.2 cancellation. I've scribbled it out. I did do the T accounts for it. 16.9, 15.7, 12.5. Cash, per the question, is 9 and 6. But there's also this 1.2 in transit, 2.7, and that will give me a total of 23, 2, 10, 16, carry 1, 10, 126, 300, 126.3. Shares. These shares have been recorded. Pyramid, right at the top of the question, Pyramid has recorded the share exchange, but not the cash consideration. So the shares in Pyramid, 25,000, already reflects the share for share exchange. Premium, if they recorded the shares, they must have recorded the premium. So 17.6. Retained earnings, that's in working 3. Working 3 said retained earnings were 36,325. Well, that's not looking good, is it? 300, and we've got 325 here. NCI, that's in working 4A. Never mind, keep going, keep going. 8535. That's looking better already. So 20, 30, 60, 70, 86, 87, 460. Then we've got long-term debt, deferred tax. Oh, and we got the loan as well, the loan notes. 11% loan notes. We've got 12,000 of our own, and we've got 4,000 minus 2.5 intercompany, 1.5, 13.5. And the deferred tax is 4.5 plus the 1 in the subsidiary, the fair value adjustment, which was not so far recorded. So that's 1987, 1906, 460. Not looking good at all, ladies and gentlemen. Current liabilities, per the question, 9.5 and 5, that's 14,500. And we have this deferred consideration, was deferred, it's now current. Previously ex-deferred consideration. What did we say? It was 640, I think. Yeah, 640. The unrolled discount. No, not 640. That was the unrolled discount. Deferred consideration is 6,004 plus 640, just 7,040. I don't know whether that's it. Let me just see. Current tax, current liabilities, no. We'll have a look and see anyway. A60. Oh, 120, 128, 128,000. What have I forgot? The current liability minus 3.2. The cancellation of 3.2. Yeah, okay, 3.2, but plus the purchase. Do you remember I had to write something in for the purchase? I had to write in, how much was it? 1.5. Yeah, the goods which were in transit, they had not previously been recorded, so I needed to increase the current liabilities by 1.5 before I could then cancel the 3.2. So let's take that 14.5 out. 9.5, 14.5, 15.5, 16, 12.8. Now let's see, 110, 126, 300, 126, 300. Okay. And the time is 14.16, and we were meant to finish at 14.26. It's doable. I read time and time again. I read particularly a lot of heavy criticism of the F5 examiner this time. Unjustified, I think. The exam has to be hard. What's the satisfaction? What's the point of an easy exam? What's the satisfaction of passing an easy exam? Exams are meant to test you. If you're prepared, if you'd gone through question 1s, 2s, 3s, 4s, because most of them are on the site, most of them are on the OT site, most of the workings are there. There's no real excuse for being under-prepared for F7. And so I'm sorry, but I don't have a lot of sympathy with you. I will say that I'm glad that I don't personally have to do the exams, but there again, I did mine, and to qualify as an ACCA, you've got to be tested. Otherwise, it's a qualification not worth having, and that would be a disaster. Okay, so 14.26 was finish time, 14.18 it is now. We did finish at 14.16. I don't think there's anything more I need to say. Quite honestly, you know, this was one of the easier question 1s. There was not really a lot to it. The tricky bit, I think, was the current accounts and the reconciliation, the in-transit items. But come on, that breaks it down into its component elements, and there's nothing in the component elements, there's nothing which should have thrown you. Nothing at all. Alright, I'm going to go straight on to question 2. I'm going to take a break. I said I'm going to go straight on. I'm going to take a break because admin has to break these down into bite-sized exercises, bite-sized chunks. So I'm going to stop this recording now and come back to it and then do question 2, which is fresco. Oh, and there's a bit of earnings per share calculation to do with. Alright, so enough of that. I'm going to stop now.